Welcome to a primer on Retail Central Bank Digital Currency, an open learning course hosted by the SEACEN Centre. I am Srichander Ramaswamy, Director for Financial Stability, Supervision and Payments at the SEACEN Centre. As digital money proliferates and cash usage declines, central banks are exploring the introduction of Retail CBDC to enhance payment efficiency and financial inclusion and to safeguard monetary sovereignty. This course, delivered through an open learning platform, examines what impact a retail central bank digital currency can have on our current monetary system that relies on a two-tiered fiat currency architecture. No prior expertise is required for following this course, just curiosity about the future of money and its impact on the economy. The usual disclaimer applies. The views I express do not necessarily represent the views of the SEACEN Centre or its member central banks. Let me begin with some introductory remarks about this course. This course aims to provide foundational knowledge on retail CBDCs and explain how their introduction may impede or complement the existing fiat currency-based monetary system. The background to this is that many central banks around the world are studying the pros and cons of introducing retail or wholesale central bank digital currencies to complement the fiat currency system that has come to dominate our current monetary system. This open learning course, as I mentioned earlier, focuses on retail CBDC. On this front, some central banks are in a learn but not launch phase. Some others have already launched a retail CBDC. A retail CBDC is a direct central bank liability. Questions therefore come up as to whether issuing a retail CBDC may in some ways impede the central bank's key functions. Among others, these include the following. Will the commercial bank's money creation process be disrupted? How will it impact the efficient transmission of monetary policy? What role can central banks play to ensure that the demand for credit in the economy is met at reasonable price terms? Will the remit of the central banks need to broaden in scope and reach? The open learning course aims to provide some indicative answers to these questions and is structured under 3 modules. The first one introduces learners to the fiat currency-based monetary system. The second module examines the design choices and implications of introducing retail CBDC into the current monetary system. The third module explores the following question. Does retail CBDC have a use case? Let me begin with the first module, which covers the fiat currency-based monetary system. A fiat currency-based monetary system is one in which money derives its value not from a physical commodity like gold or silver, but from government decree and the collective trust of the people who use it. The fiat currency has no intrinsic worth. Its value is established and maintained by the authority of the issuing government, primarily through central banks. Fiat currencies dominate the modern global economy, and it relies heavily on stability, transparency, and the confidence in the institutions that oversee it. This system gives central banks greater flexibility in managing economic activity as they can regulate the money supply to respond to inflation, recession, or other economic challenges. The conduit for regulating money supply is through commercial banks in the modern monetary system. The focus of the first module will be in understanding the interactions and the interconnectedness between central banks and commercial bank balance sheet. There are two actors in the economy: central banks and commercial banks. The phrase "it takes two to tango" is an English idiom that means some actions or situations require two people to make them happen. The leader and follower part comes from the actual dance tango, which requires one person to lead and one person to follow, highlighting that mutual participation is necessary. Central banks and commercial banks are partners in the tango in the current monetary system. While each has a distinct and differentiated role, both have a shared goal to supply adequate levels of credit to the economy at appropriate price levels. Central banks have the mandate to ensure that the quantity and the price of credits supplied by the commercial banks remain well balanced against the backdrop of the economic environment. In that respect, the central bank acts as the leader in the tango by providing vision, direction, and guidance. The follower is the commercial bank, which plays an equally important role by responding, supporting, and executing the vision. Let me briefly outline the functions and roles of each actor so that it will be easier to understand how the tango might unravel when the music stops. The central bank is the guardian of monetary and financial stability, ensuring stable prices, a sound banking system, and a resilient economy. Its main roles are monetary policy implementation. The central bank monitors and controls money supply and credit to support the economic activity. It has a mandate to control inflation and deflation, often by setting appropriate targets. And it uses tools such as interest rates, reserve requirements, and open market operations to manage inflation, growth, and employment. Issuing currency and managing the exchange rate. The central bank holds the exclusive right to print and circulate the national currency. It ensures the stability and credibility of money in the economy. It has also responsibility to maintain the stability of the national currency in global markets and to manage the foreign currency reserves. Regulation and supervision of banks. When not delegated to a separate supervisory authority, the central bank monitors commercial banks and financial institutions that ensure safety and soundness. It sets capital adequacy and liquidity requirements to build a resilient banking system. Maintaining financial stability. It has a mandate to monitor risks in the financial system and ensure they are contained. And it takes corrective measures employing macroprudential tools to manage bank lending in periods of booms and busts. Lender of last resort. The central bank provides emergency funding to commercial banks facing liquidity crisis. Takes preventive measures to ensure failure of a bank does not spread to the wider economy. Now coming to commercial banks. Commercial banks are the credit intermediaries in the economy. But they are not always willing partners in the tango. The main roles of the commercial banks are the following. Liquidity and maturity transformation. The public wants to hold redeemable demand deposits with banks that are safe to meet their immediate spending needs in the foreseeable future. Investors and entrepreneurs want loans that are long-term and also risky to finance economic activities. Banks are the intermediaries between savers and investors. Their main function is to transform savings and demand deposits into illiquid, risky, and long-term loans to support a variety of investment and entrepreneurial activities to create jobs and spur economic growth. In doing so, they perform credit screening and credit allocation decisions. They are agent of monetary policy transmission. Commercial banks play an important role in the transmission of monetary policy and as an agent for settling large value payments. Now, to fulfill this role, we need backstops and deposit insurance. So, if banks have to fulfill this role of a credit intermediary, the central banks have to provide liquidity support against good collateral. They also require banks by law to participate in a collective deposit insurance scheme to which the government provides liquidity backstop. The safety feature is fundamental in ensuring that the banks will be preferred financial institution in which public will prefer to hold their savings and receive their wages. Compliance with bank regulation. Banks are also subject to stringent oversight and regulation to build trust and reassure the public that their deposit claims on banks are safe. Central banks set capital and liquidity requirements to build a resilient banking system. To understand how central banks and commercial banks act as tango partners, we need to understand the structure of their balance sheets. So let me go through a stylized central bank balance sheet. I've shown the balance sheet of the central bank on two dates, as of the 15th of June 2025 and as of 16th of June 2025. On 15th June, you see on the left-hand side the assets, on the right side the liabilities of the central bank. So the stylized assets that central bank holds are foreign currency assets, loans to banks, commercial banks, the government securities, gold, and other assets. On the liability side, it has currency in circulation, bank reserves, the commercial bank reserves, non-monetary liabilities, government deposits, and equity. Now, let's move to the right side panel, which shows the balance sheet as of the 16th June 2025. So, the central bank wants to purchase a foreign currency asset amounting to $50 and also wants to purchase government securities in the local currency worth $50. So it has to acquire $100 worth of assets. How does the central bank do it? Well, it doesn't print money, meaning it doesn't print more currency notes that are in circulation. Rather, it simply credits this commercial bank reserves by $100. So now it has increased its liabilities by $100, and against those liabilities that it's forced on the commercial banks, it now can acquire the foreign currency asset worth $50 and government securities in the local currency worth another $50. So what happens under sterilized foreign currency intervention? The central bank will conduct an open market operation in this case where it will sell $50 of the government securities to commercial banks and debit their reserve accounts by 50. In other words, it's going to sell the government securities and debit this against the bank reserves. And that would result in a sterilized foreign currency intervention. Coming to the stylized commercial bank balance sheet, we again have the balance sheet of the commercial bank on two different dates, one on the 15th of June, and on the right side is on the 16th of June. So let's assume that on the 15th of June, the commercial bank balance sheet on the asset side has currency in vault and ATMs, bank reserves, government securities, bank loans, and other assets. On the liability side, it has customer deposits, loans from central bank, bank bonds it has issued, certificates of deposits it's issued, and equity. So on the next day, the 16th of June, let's assume that the central bank has done a quantitative easing in terms of crediting the bank reserves by $50. So it's increased the commercial bank reserves by $50. The way it would have increased the commercial bank reserves by $50 is buying a government bond, let's say a government bond or a bill worth $50, which will go into the asset side. And this $50 would typically, the government bond would have been sold by a private sector person. And the private sector person, the intermediary of this bond sale would have been facilitated by the commercial bank. And the person the private sector person who's selling this bond, the $50, his account will be credited or and it will show up on the liability side of the commercial bank of a $50. Let's assume that the bank decides, now that its bank reserves has increased by $50, to extend the bank loan of $50. Well, if it does increase the bank loan by $50, extends a loan to a customer, the customer's account with the bank will be credited by $50. So the $50 plus the $50 is $100. The deposits increase by $100. And this is balanced against an increase in commercial bank reserves by $100 on the asset side. And the bank now has a new bank loan, which is a claim on the individual for a $50. So its assets have also gone up by $100. So one may ask the question, why does the bank not increase bank loans by $100 or even more? Because typically when the bank reserves go up by $50, the commercial bank can lend a lot more, assuming that the cash reserve ratio is not 1-to-1. That is, if it has a cash reserve ratio of, let's say, 10 and $50 of bank reserves have increased, it can actually lend out $500. I'll get to that because that will come from the constraint whether the bank has enough capital. Now, this slide basically shows that the commercial bank and the central bank balance sheets are interconnected. In fact, that's very essential if you want to conduct monetary policy, because the transmission channel of monetary policy really takes place through the commercial banks. So here is again the central bank balance sheet and the commercial bank balance sheet. And the interconnectedness of the two balance sheet, the central bank and the commercial bank balance sheet, happens through the bank reserves. So on the liability side of the central bank balance sheet, you have bank reserves, which is the liability to the commercial bank. And on the commercial bank, it becomes an asset. So the bank reserves become an asset, and it's basically the liability of the central bank. So this connection between the bank reserves on the liability side, on the asset side of the commercial bank, is the interconnectedness of the balance sheet of this the central bank and the commercial bank. At the same time, the central bank and the commercial bank balance sheets can also be interconnected through any loans that a central bank gives to commercial banks. So if it extends a loan to the commercial bank, it becomes an asset of the central bank. And that loan from the central bank shows up on the liability side of the commercial bank balance sheet. And the question is, when will commercial bank switch the $50 bank reserves into bank loans? Because essentially the bank reserves is not providing any funds or loans to the investors for investment activity. So the bank reserves really doesn't provide any stimulus to the economy. So what are the conditions under which these $50 of bank reserves will be at least part of that will be transformed into bank loans? Again, that depends, of course, on the demand and supply for demand for loans. But the supply of loans will also be constrained by the fact that the commercial bank has to comply with the Basel regulation in terms of capital adequacy ratio and in terms of liquidity ratio. So if it doesn't have enough equity capital, it cannot extend loans. Again, I'll come back to this issue at a later point because it's actually very important. So turning to the next slide, the conduct and transmission channels for monetary policy. So first of all, what is monetary policy? Well, monetary policy refers to the process by which central banks manage money supply and interest rates to achieve economic objectives such as price stability, full employment, and growth. And how is it conducted? Its conduct involves setting the stance of the policy, either expansionary to stimulate demand or contractionary to curb inflation, to instruments like policy interest rates, cash reserve requirements, and open market operations. The effectiveness of the monetary policy depends on its transmission channels, which are the mechanisms through which the policy decisions influence the real economy. So, what are the transmission channels? So, the transmission channels are the interest rate channel. The interest rate channel works by altering the borrowing costs affecting consumption and investment decisions. It is implemented through changes in the central bank policy rate. The credit channel reflects how policy affects banks' lending capacity and the availability of credit. This can be implemented through changes in reserve requirements or by altering macroprudential buffers. The exchange rate channel influences trade competitiveness by making exports cheaper or more expensive. This is implemented through foreign exchange intervention. The asset price channel affects household wealth and corporate financing through changes in stock and real estate values. This can be implemented through purchases of long-term government securities, which essentially is quantitative easing. Just remember that central banks cannot control spending or investment directly, but they shape the incentives and financial conditions that guide economic activity. The commercial banks are the main conduit through which monetary policy is transmitted. So now coming to the money creation process. What is money? Money is anything generally accepted as payment for goods and services, serving as a medium of exchange, a unit of account, and a store of value. So what are the different aggregates for money supply? Central banks classify money supply into different aggregates commonly labeled M0, M1, M2, etc., depending on liquidity. That is, how easily the asset can be used as money. Coming to M0, which is the monetary base or the reserve money, it is the most liquid form of money, and it includes currency notes and coins in circulation with the public and cash reserves held by commercial banks with the central bank. M1 or narrow money, it measures money readily available for spending and includes currency with the public, demand deposits with commercial banks, and other deposits that are withdrawable on demand. M1 includes M0 in the measurement. M2 or intermediate money, it adds savings components and includes M1, savings deposits, and short-term deposit. It captures money that is not immediately spendable but still relatively liquid. Just to give you an example of what is the composition of M1, M2, and M3 in the United States, as of June 2025, you see M0 is $5.75 trillion, of which currency in circulation is $2.4 trillion. M1 is equal to $18.8 trillion, and M2 is equal to $22 trillion. So M2 is significantly more than M0. And remember that the currency in circulation and the reserves, the central commercial bank reserves held at the central bank, primarily comprise M0. Now, if a central bank decides to print banknotes, it's going to only have a very small impact on money supply, because sometimes there is this feeling that central banks create money. Of course, it can create money two ways. One, it can print banknotes, but the amount of banknotes that it can bring into circulation is very limited. The other way is the quantitative easing, where it basically increases the commercial bank reserves. So that's two ways in which M0 can be increased. So now coming to the money creation process. The question that we need to ask is, who can create money in the economy? That is, increase money supply. Central banks can increase money supply by increasing M0. As I said earlier, this could be by printing banknotes or by increasing the reserves held by commercial banks through acquisition of assets from the private sector through commercial banks. The increase in money supply will be small. Now, commercial banks can create money resulting in an increase in M1 and M2 through what is known as fractional reserve banking. When capital is not a constraint, banks can increase money supply by 20 to 50 times the amount needed to be held in the commercial bank reserves. The only constraint becomes the cash reserves ratio. How do commercial banks create money? Well, when a commercial bank gives a mortgage loan of $100 to a retail client, which you see here. So it gives $100 bank loan. The retail client's deposit account will be credited with $100, which is the commercial bank's liability. On the asset side, the commercial bank will be recording a mortgage loan to the client, which is this $100. The bank's balance sheet will expand by $100, and the money supply M2 will also increase by $100. Note that when a central bank increases M0 by $5, is so much smaller compared to a commercial bank's capacity to increase money supply by factor of almost 20 in this case. So it's pretty much creating money out of thin air by simply extending a bank loan and depositing $100 in the retail customer's bank account. So the real agent that creates money in the economy is a commercial bank. So let's get to the very last slide of this presentation, which is the balance sheet constraint of commercial banks, because I have been alluding to this balance sheet constraint essentially coming from the capital of the commercial banks. That is, even if the central bank increases the bank reserves so that commercial banks can lend against the increase in bank reserves, it's not always the case that the commercial bank is willing to actually lend money and increase money supply. In fact, for instance, if a central bank reserves increase by $5, the commercial bank can lend, say, $100. I'm assuming here that the cash reserve ratio is 5%. So if 5% is the cash reserve ratio, a $5 increase in bank reserves will allow the commercial bank to lend $100. But the capital requirement, if a commercial bank has to lend $100, the capital requirement will be $5 for a $100 mortgage loan. I'm assuming roughly about 40% risk-weighted risk weights. And the capital ratio that the bank has to maintain is roughly about 12.5%. So if I make the assumption that the capital ratio should be 12.5% and the risk weight for this particular mortgage loan is 40% risk weight, it's going to need $5 in capital to extend a $100 mortgage loan. Well, if the bank doesn't have the capital, it's not going to extend that particular loan. So even if a central bank policy rate is lowered and there is demand for loans, the banks can only lend if they have enough capital. So here is some interesting graphs. If you look at it, just after the global financial crisis, the balance sheet of the Federal Reserve and the US commercial banks, bank holding companies. And on the right side here, you see the ECB balance sheet and the Euro area banks, the balance sheet of the Euro area banks. So what the Fed did is that they increased, through the quantitative easing, the Fed balance sheet rose from about close to almost 0.1 trillion or something like it. It rose to about 3.5 trillion in December 2014. And you can see that the commercial banks simply just kept step with the increase in the Fed's reserves, because as the Fed bank reserves rose, so does the asset side of the commercial banks, but they never extended additional loans. It hardly ever did. It's only subsequently when enough capital was built up by the US banks, the loan supply started increasing. If you look at the right side of the chart, the ECB started increasing when they did the quantitative easing, they started increasing the bank reserves with the hope that the commercial banks will lend money. But what happened is that even as the ECB increased its reserve, the commercial bank reserves, you can see a sharp fall in the total assets of the euro area banks. Basically, they were deleveraging because the Greek crisis at that point in time hit, and a lot of euro area banks were short of capital. And the one thing that they did is essentially to deleverage. So even if a central bank wants to introduce quantitative easing and supply a lot of commercial reserves, central bank reserves, it is not always the case that the commercial bank is willing to lend because it may have capital constraints. So this chart very nicely illustrates the fact that the commercial bank's decision, commercial banks is the one that really decides whether the money supply in the economy is going to increase or not. It's not really determined by the central bank. The central bank can actually facilitate the money supply to increase, but ultimately it's the decision of the commercial banks whether to increase or not. So with that, let me thank you for your attention, and I hope you will continue with module 2 of the course.